September 2008. A 158-year-old bank collapses. Overnight. 600 billion evaporates, pension funds vanish. Millions lose their jobs. But what if I told you? The real cause started with a lie. So simple it could fit on a billboard. Why rent when you can own? Upbeat music plays. 2002. America is still reeling from the dot-com crash. The September 11th attacks deal a heavy blow to the economy. Wall Street is stretched to the limit. But don't worry, the Federal Reserve had a plan. They slashed interest rates to near zero. Suddenly money was cheap and borrowing easy. And suddenly America's national pastime was no longer baseball. It was buying houses. Congratulations, your $100,000 loan is approved. But we only earn $40,000 a year. No problem, adjustable rates apply. Principal payments deferred, or ninja loans. Ninja loans, what's that? No income, no job, no assets. It doesn't matter. In the early 2000s, homeownership wasn't just about a roof over your head. It was the American dream, symbolizing stability, status, and peaceful suburban life. This message was everywhere: TV ads, billboards, financial seminars, all echoed it clearly. Why rent when you can own? Banks fully agreed, even more enthusiastically than buyers. They started throwing money at people like it was a game show, and everyone won. Then came subprime mortgages. Simply put, these were loans for people with poor credit, unstable income, or even no understanding of how money works. Bad credit? No problem. No credit? No problem. Living in a van? You qualify for a luxury condo. Do I need to worry about repaying it? Not an issue. If you can't pay, we'll sell the house for a higher price. It was a real estate gold rush, a collective mania. Everyone rushed to buy. Home prices soared. Your neighbor's house doubled in value in just 6 months. And people thought it was normal. Even part-time McDonald's employees or baristas with $5 in savings were approved for mortgages. Just an ordinary day in the 2000s. And the regulations? Thrown out the window. Traditional lending standards were considered too slow. Risk assessment was boring. Down payments optional. As long as you breathe, you could get a mortgage. People bought houses like instant noodles. Lenders printed contracts like monopoly money. Mortgage brokers earned commissions faster than they could say bubble. Behind the frenzy was a blind belief that home prices would keep rising, because they always had, until now. But behind the bustling open houses and shiny homes, there was a lingering question. Could anything go wrong? The answer, yes, almost everything. And this was just the beginning. By 2000, buying a house was no longer about living in it. It was about flipping it like a pancake, hoping the next buyer would pay double. Houses were no longer homes. They became lottery tickets. I taught during the day and bought condos at night. I just bought my third house with no down payment. I didn't even live in any of them. Here's your coffee. Sorry for being late. The bank just called offering another property, a penthouse in Miami. It wasn't investing anymore, it was an addiction. The whole country was flipping properties repeatedly. The more people joined, the higher the prices went. The higher the prices, the more people rushed in, like trying to put out a fire by pouring gasoline. And everyone held a light. But beneath the glittering was rot. Those subprime loans everyone jumped on were actually terrible, extremely risky, opaque, with nearly unverifiable debt. But Wall Street had a magic trick. They bundled up all that junk and relabeled it, then sold it to investors as if it were safe. Introducing mortgage-backed securities. Now at 80s lives. Turning toxic loans into gold was easy. Just get the credit rating agencies to label them A, even if the borrowers were baristas, bankrupt or unemployed. No problem, give them a high rating. And here's the part they never advertised. The credit rating agencies were paid by the very banks. They were rating, like hiring a food critic, and saying they won't get paid. Unless they call your raw chicken Michelin worthy, behind closed door. The raters knew those assets were junk. But Wall Street didn't stop. They mixed those risky mortgage packages to create something even more complex. Collateralized debt obligations through financial alchemy. Junk loans became high-end investment assets. Yet not everyone was fools. A small group of eccentric investors, and contrarian, read every fine print carefully. They saw the rot inside the boom, the prosperity, and instead of buying like everyone else, they asked a bold question. What if we bet against it? The problem was, there was no financial instrument to do that. So they went to Wall Street's marble halls and said, these loans are junk, we want to short them. Can you create something to help us make money if these loans fail? You want to bet against the housing market? Sounds cute, okay? Want insurance? We'll write the contracts. You pay monthly fees. And if nothing happens, we pocket all the fees. Sounds cute. All right then. You want insurance? We'll write the contracts. You pay monthly fees, and if nothing happens, we pocket all the premiums. Everyone wins, especially us. I mean, could this whole system really collapse? Wall Street smelled easy money. They didn't believe those investors, but they liked the idea of steady fees from something they thought couldn't fail. So they got to work and created something that would blow up the global economy. Credit default swaps, or CDA. Basically, these were insurance contracts that paid out if the mortgage-backed investments became worthless. Three strange things. You didn't need to own the investment to buy insurance. Like taking life insurance out on your neighbor and secretly hoping she trips on the stairs tomorrow. The next day, the whole system was like a Jenga tower, built from lies and financial leverage. Each block was a bad loan, each level a riskier gamble. And at the top, they toasted, another record bonus in hand. When money flows easily, who needs ethics? Whistleblowers ignore. Regulators asleep. Executives too rich to care. Too greedy to stop. The party continued while the floor started cracking. At first, small fractures. A mortgage delinquency here. A foreclosure there. A vacant condo in Vegas, but then the wave hit. The impossible became a headline. House prices are falling. House prices always go up. That's basic economics. People still believed it. A price drop was unthinkable. For years, the housing market was like a Jenga tower, gigantic, built from lies, greed, and blind optimism. But by 2007, someone pulled the wrong block. Subprime loans, risky contracts wrapped in glossy packaging, started to collapse, and the mortgage-backed securities built on them. Yes, they were ticking time bombs. And then they exploded. Banks, who thought their portfolios were full of safe assets, suddenly realized they were holding radioactive financial trash. Those A investment packages were essentially financial plutonium. We can't sell this junk, so its value is zero? Exactly, we're done for. Panic spread like wildfire. Hedge funds were losing massively. Money evaporated uncontrollably. Investment banks reported tens of billions in losses. Then, boom, Lehman Brothers. A 158-year-old institution disappeared. No bailout, leaving only a $600 billion hole on the street. Sad. The message was clear. If Lehman could die, anyone could. Overnight, banks stopped lending to each other. The credit market froze completely. Like someone unplugged. The global economy. I need a loan to pay salaries. Sorry, we're out of liquidity. What does that mean? It means we're closed. Good luck, everything's blocked. Families couldn't get mortgages. Businesses couldn't pay salaries. Investors couldn't withdraw funds. Retirees watched their pensions evaporate before their eyes. 401ks vanished. Life savings gone in an instant. The job market evaporated too. By the end of 2008, everything had completely collapsed. Millions unemployed. Mass foreclosures. Eviction notices piling up like junk mail. Charity kitchens. Places handing out food to the hungry and homeless. Couldn't serve in time. Offices. Unemployment offices looked like disaster relief centers. After the disaster, not only was Wall Street burning, but Main Street, where ordinary people live, and work, was also in freefall. And the fire didn't stop at America's borders. Big banks in Iceland collapsed. Tokyo's stock market plunged. European leaders panicked, trying to respond. From London to Riga, from Tokyo to Sao Paulo. Markets crashed, banks wobbled. The global economy spiraled into chaos. By then, the question wasn't who would fall next, but whether the entire system could survive. The Great Recession officially began. The U.S. government faced an impossible choice. Let everything burn, or pour hundreds of billions of taxpayer dollars into the pockets of those who started the fire. October 2008. They chose the second option. I need $7 billion for what? To throw into the burning banks before the entire system explodes. And so began the bailout program. The Troubled Asset Relief Program. Simply put, they gave Wall Street a pillow, $700 billion to fall softly, because these banks were too big to fail. If they died, the entire global economy would die with them. So the government did what it had to do. They started dropping money from helicopters. Seriously, bailout loans. Buying any kind of stock. As long as the system survived. If your financial statements were smoking, the government would bring the fire hose. And not only banks received special treatment. AIG, the insurance giant, bet trillions on financial junk. Got over $180 billion in bailout. Even car companies like GM and Chrysler were pumped $80 billion, an unprecedented financial rescue. Since the Great Depression, in the 1930s. Meanwhile, at the Federal Reserve, Ben Bernanke was rewriting the rules of economics with monetary artillery, interest rates cut near zero, borrowing almost free. Then the biggest move appeared, quantitative easing, meaning they started printing money out of thin air to buy bonds and bad mortgage debt. Imagine patching the Titanic with $100 bills. Don't worry, I'll handle it. And strangely, it worked. Markets gradually calmed, banks eased up. The stock market hit bottom in March 2009, then started crawling back up Wall Street. But Main Street, where real people live, was still choking on smoke. The consequences were brutal. Unemployment reached 10%. 8 million jobs lost. 4 million homes foreclosed. $19 trillion. Household wealth evaporated massively. Families that never missed a payment suddenly owed more than their house was worth. And people were outraged. Wall Street got bonuses again? I just got evicted. And they get bonuses? Those who caused the crisis were rescued. Those who suffered got food stamps. Wall Street popped champagne to celebrate. Main Street queued for soup. And then the anger erupted. 2011, Ducati Square. New York, thousands gathered, pitched tents, beat drums. Holding signs. One read, "We are the 99%. Now it wasn't about bailouts anymore, but a system built to protect the powerful. Profits privatized. Losses socialized. Justice completely disappeared. No major Wall Street CEO went to jail. No handcuffs, no public shaming. Only golden parachutes and comfy retirements. The system survived, but trust burned away. A generation grew up realizing, when banks make mistakes, they are rescued, but when you make mistakes, you are crushed. Because if 2008 taught us anything, it's this: the next crisis won't look like the last. It will seem harmless, profitable, seem inevitable until it isn't.